Well, welcome to our High Rock clients and any other listeners who have joined us this week, and thanks for taking the time to tune in to our weekly webinar where we're going to talk about what we see happening in the global economy and financial markets and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategy. We are recording this webinar, so those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson. I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock. Our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we certainly invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. Well, let's review our themes for 2016 before we get started on what happened last week. Our first theme was that financial markets will be volatile. And certainly that's been happening on a regular basis so far this year. Second theme, there's a big question mark surrounding the U.S. economy. Will it follow the U.S. Federal Reserve's optimistic outlook, or are less positive forces going to pull it down? Commodity prices are having a deflationary impact. Can non-commodity prices offset this? The central banks of Europe, Japan, and China are adding stimulus. The Bank of Canada and the Bank of England are holding steady, and the U.S. Fed is tightening policy. That certainly is a recipe for more uncertainty. And we can throw in the geopolitical wildcards here as well. And as they always have been, bond markets continue to hold the clues. We think equity markets remain expensive, although certainly at this point somewhat less so than they have been. But we remain in a time of lower than average returns after 6 years of above average returns. As all things do over time, we are now moving back towards the average. So what's happened since our last webinar? Well, let's get right to the financial markets. It has been a pretty wild ride. Volatility spiked again last Wednesday, well above the averages, but well below the spike we saw last August. CNN Money's Fear and Greed Index hit a low near 9, representing extreme fear before it bounced higher today. But things did not get as fearful as they did last August. Canadian bonds were weaker, while U.S. bonds were a little stronger. High-yield bonds were also up on the week. The U.S. and Canada 10-year bond yield spread narrowed by 11 basis points as the Bank of Canada unexpectedly held interest rates steady. Despite the volatility, our benchmark world equity index was better by about 1.5% and is now lower by a little over 11% on the year. China was the worst performer since last Tuesday. Canada was the best performer, and now that's a bit of a change. In fact, in December on BNN's The Close, I suggested that it might be a reasonable strategy to be overweight the underperforming Canadian equity market and underweight the outperforming U.S. equity market for rebalancing purposes. So far, that strategy does appear to be working. Well, our benchmark world equity index made a new low near 49 last Wednesday, which was the equivalent of a 22% drop from the highs before it found buying support. The downtrend, however, remains intact as we are now experiencing lower lows and lower highs. Until this pattern is broken, we should be on our guard. However, we are using better values to nibble away at this opportunity, although we are still sticking to our overweight cash thesis. Commodity prices bounced a little Since last Tuesday, oil is up by over 5%, but for now the trend remains downward. After oil hit new lows last Wednesday, it rallied on Thursday and Friday, and then again today. But for the moment, that downtrend remains well entrenched. Well, last week we talked about the laws of supply and demand and the International Energy Agency's outlook. They see oversupply until late 2016 and no increase in demand. Well, Economics 101 suggests that when supply exceeds demand, prices should fall, and so they have been. And Iran's supply has obviously added to market concerns. Well, historically, lower oil prices have been a benefit to economic growth. However, in this case, the steep plunge has financial markets worried. Uncertainty as to how this might impact financial institutions as bad home lending did in 2008 has investors on the defensive. The selling of risk assets creates more volatility, and consumers and businesses postpone their spending until they feel more confident, and that is not good for economic growth. As has been the case, the Canadian dollar has followed oil, but when the Bank of Canada held interest rates steady, when a majority of the market had expected a rate cut, the Canadian dollar got an additional boost, moving from a low near 68 cents last Wednesday to better than 71 cents at the close today. The Canadian dollar did hit levels not seen since March of 2003, last Wednesday. Well, our benchmark World Equity Index is comprised of about 52% of U.S. companies, so we keep a close eye on what is happening in the U.S. economy. Well, the U.S. Federal Reserve raised interest rates in mid-December, citing that they saw improving economic conditions and expected inflation to move toward their target 2% level. And that future increases were expected to be gradual. They meet and will announce any changes to their outlook tomorrow. We do not expect any interest rate changes. With a particularly optimistic economic outlook, the U.S. Federal Open Market Committee members suggested an average of 4 interest rate increases in 2016. We would suggest that they might be tempering their enthusiasm with the recent economic data and market turmoil. December retail sales were disappointing. U.S. jobless claims are rising. Inflation is not rising. In fact, fourth quarter U.S. GDP expectations have continually been revised lower, leaving plenty of uncertainty as to the validity of the 2.5% GDP growth expected for 2016. Well, around the rest of the World Economic Forum held its annual meeting in Davos, Switzerland last week. A forum report released at the start of the meeting predicted that by 2020, 5 million jobs will be lost as a result of technological changes. The result of the fourth industrial revolution. This, among many others, was the key theme. In the background, of course, however, were the current state of financial markets, and central bank intervention was a very hot topic. Well, the euro area companies represent about 16% of the World Equity Index. The European Central Bank eased monetary policy on December 3rd, but it was less stimulative than the market had expected. Last Thursday, amidst the increasing market volatility, President Mario Draghi surprised the market with an announcement of more stimulus to come in March. Now, this halted the selling on financial markets and brought buyers back into the equity markets. Well, Japanese companies represent 8% of the World Equity Index, and the Bank of Japan will announce their latest decision on interest rates on January the 28th, in 2 days' time. Expectations are for further monetary stimulus. Companies in the UK represent 7% of the Global Equity Index. On January the 14th, the Bank of England Monetary Policy Committee voted by a majority of 8-1 to maintain the bank rate at 0.5%. Policymakers said the outlook for growth and inflation had weakened. Chinese companies represent 2.5% of the world equity index. The Chinese central bank injected the equivalent of almost US $20 billion into the financial system at the beginning of January. And Chinese economic growth stalled, growing at an annual 6.8% in the fourth quarter of 2015, slightly down from 6.9% in the previous quarter and the weakest since the first quarter of 2009. In Canada, where companies represent 3% of the world index, the Bank of Canada surprised the markets, who had priced in a 60% of a lower bank rate at its meeting last Wednesday by leaving interest rates unchanged. At the same time, they released their monetary policy report for January, which mirrors some of our key themes for 2016. Divergence is one, China as a wild card is another, and of course, concern about lower oil and commodity prices. Economic activity in Canada has recently been weaker than was anticipated in the previous report last October, largely because of lower commodity prices. Further, Canada remains dependent on the U.S. economic situation for what is expected to be a better second half of 2016. However, we have to remember that last year that was the same call by the Bank of Canada. They were rather optimistic on the U.S. economy being able to help the Canadian economy along. That certainly wasn't the case last year. We are concerned that that may not be the case this year. There are significant risks, a key one being the potential impact on the financial system of failing energy companies. Well, the Bank of Canada has done what it can, and according to them, it is now the federal government's turn. So the Bank of Canada has decided to wait to see what the federal government will do before they make any adjustments to their monetary policy going forward. But what do we see on the horizon? Let's go to the bond markets, who, as we often say, tend to lead other financial markets. Government bond yield curves remain positively sloped and slightly flatter in Germany, with anticipated stimulus from the European Central Bank. The U.S., Canadian, UK, and Japanese curves have flattened as investors have been moving out of risk assets. Historically, high-yield bond markets lead equity markets. 3 weeks ago, the gap was quite wide, as you can see on this chart, suggesting that equity markets should fall further, and so they did. Now with high-yield bonds, and now high-yield bonds are telling us that we may have a temporary bottom in equity prices. So we are looking for buying opportunities if and when they may arise. As for equity markets, when investors buy stocks, they buy a stream of future earnings. The price-to-earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.2 times. The 12-month forward price-to-earnings ratio is currently at 14.9. At the equity market highs back in May, it was at 17.1. So equity prices, the green dotted line, have definitely become cheaper in recent weeks. But until they move below that blue line, we think that they are still somewhat expensive. For all of 2016, analysts are projecting earnings increases of 5.9%, which has been revised lower, and revenue growth of 3.4%, also now revised lower. As for the other metric that we like to look at, enterprise value to earnings, well, S&P 500 companies are now valued at current market prices at about a little over 11.5 times. The long-term average is 10 times, so at the moment, still rather expensive for our tastes. When investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell. So margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May, so it is something that inspires our current caution. When the spread between large cap markets like the S&P 500 widens over small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. That had been happening, and there had been a reasonably wide gap between the S&P 500 and the Russell 2000. But as markets fell last week, that gap narrowed considerably. The fact that large cap markets have rebounded but not the small cap markets leaves us a little bit concerned and somewhat cautious at the moment. Well, what does it all mean? As we often say, our discipline is to, at all times, protect our and our clients' capital, and especially so when we see the warning signs of potential problems. We are not alone in this thinking. Cash and cash equivalents are important defensive assets. We cannot stress this enough, and I say this each week. So we are carrying greater than normal cash balances in our models. However, with equity market values having fallen so rapidly to begin 2016, we have begun to find some opportunities to add reasonably cheap assets. Now, this does not change our defensive strategy, but risk is significantly lower now than it was last May, about 22% lower according to our benchmark World Equity Index. So we are much more comfortable adding some assets at where we do find value. Our HIROC models are built to incorporate the need for diversity and balance with fixed income, global equity, and tactical mid and small cap companies. As volatility increases, the cash and client accounts, the underweight nature of our exposure to equity markets, and the negative correlations between equity markets and bond markets helps to mitigate the impact of volatility on our portfolio. So far this year, our global benchmark equity index is down by a little over 7%, as I mentioned earlier. A typical 60% equity portfolio and 40% fixed income portfolio built with our models is down somewhere between 1.5% and 2%. This is a significant mitigation of risk and volatility. HIROC clients should have received their quarterly updates for the fourth quarter of 2015. As always, we remind you that we are available 24/7 if you wish to discuss your situation in greater detail. Well, what's up for next week? Well, tomorrow, as I suggested, the U.S. Federal Open Market Committee will announce their interest rate decision. That will be very widely watched, not because we expect any interest rate change, but for the wording of the text that the Fed will deliver. Investors and market participants will be looking very closely to see if there's been any changes in the wording. On Thursday, we get the fourth quarter GDP from the United Kingdom, and we'll also see business and consumer confidence from the euro area. As I mentioned earlier, we'll also get the Bank of Japan's interest rate decision. On Friday, we'll get a glimpse of the most recent data on euro area inflation. In Canada, we'll get the somewhat outdated November GDP, as well as the fourth quarter GDP from the U.S. Next week, we'll get some manufacturing data from China, from the UK, from the euro area, and the U.S., as well as the U.S. Personal Consumption Expenditure Price Index, which is the metric that the Fed follows as its gauge for inflation. So lots of stuff happening next Monday. We will be watching that very closely. All right, well, that's it for today's discussion. If anyone who is listening might have a question, we are here. Please feel free to ask it now. No questions this week, but I do remind you, if you have questions and wish to email us, we would be more than happy for you to send them. We would also love to get feedback on these webinars, what you think is good, what is not, or what else you might like to see us cover on these calls. As always, thank you for taking the time to tune in. We wish you an excellent rest of the week and a great weekend. We will return with another webinar next Tuesday. This is Scott Tominson signing off.